Welcome to Long Story Short, a podcast where two financial advisors, one rooted in financial planning, the other in investment strategy, break down the questions we're actually hearing from our clients. Each episode, we tackle one or two real-world issues that matter to high net worth individuals, from market-moving news to personal finance decisions with lasting impact. No jargon, no fluff, just clear, thoughtful insights from the front lines of wealth management. We keep it short, but we don't cut corners. This is Long Story Short.
So we joked at the end of last week's episode about what we were going to be dressing up for Halloween this week, and I did not live up to the task. I'm dressed as a financial advisor reporting for
Yeah,
work on a
you're
Monday. You are
you're doing a good job of that, by the way.
okay.
Yeah,
I put a lot
you're,
of
you're
effort
giving
in my
off you're giving off financial advisor vibes for sure.
Spirit Halloween had a discount on this costume running this weekend. So, but you, on the other hand, for those that can't see it or just listening. Andy really did live up to the bill and is dressed as
I'm an index fund.
you are an index fund. Okay, well, tell us about, I feel like this is, the red carpet at the Oscars. Tell us, what are you wearing and tell us all about it.
All right, so real quick, I've got for those of you who are listening, I took a bunch of colorful paper that we have here at the office, wrote a bunch of tickers on it, roughly sorted them by market cap. So I've got Nvidia, I've got Microsoft, I've got Apple, I've got all the big names here in these big rectangles. And then as we go down, we've got some smaller big companies like Walmart and Tesla and Oracle and JP Morgan. And then I kind of ran out of space to write tickers on them, but I got a bunch of smaller squares here as well. And I
You
think
have all 500?
I think that, well, so I didn't quite have time. We don't have any interns here right now, so I couldn't have anyone do all 500 for me. Maybe if we had some Halloween interns, that could do it. But it's roughly the case that the front of my body are like the top 10 names. And if I did do 500, it'd probably wrap around my back, but with some very, very small squares because the average market cap of a mega cap stock right now, kind of all combined, like the top 10, it's like what, 35-40% of the S&P
I was
500?
going to say, you don't even need all 500. You've got most
Yeah,
of the market right
got it
there on
right
just a
here,
couple sheets of
right,
paper.
right on the front. So
Yeah,
I
well, if it makes you feel any better, if you came to our house, you would be awarded a king size Kit Kat bar or a
you're
Snickers bar for this
you're one of
outfit and this
those.
effort.
Oh, so you
You
have
know,
those for good Halloween costumes. Okay.
we reward creativity, we reward uh the commitment to the spirit of the night of Halloween. So, in keeping with that outfit, you've got to tell us all about the topic you're going to throw out
So
first
so
on the list this week.
right. So I wanted to dress up for the episode because it's Halloween. But I also kind of wanted to make it a little educational here as well. So you bear with me, and hopefully I can earn that Kit Kat bar with you as far as my explanation goes. So what I wanted to have, because we get clients asking us all the time about index funds, right? And should they invest in them? Are they good? Are they bad? And I have a bit of a nuanced take on index funds that I wanted to have some time to share. So again, if you're watching us live on YouTube, you can see how my chest here basically is just a bunch of really big squares that represent the very biggest companies. And I wanted to depict it this way because this is actually a pretty accurate way to look at an index fund. The very biggest stocks in the stock market make up the biggest chunk individually of really most index funds out there, right? So most index funds, so SPY, the S&P 500 index fund, or even some of those NASDAQ funds that you might invest in, the very largest companies are going to have the most pool. And so if you've been an index fund investor, you really benefited from that here recently. So, index funds themselves have been a big win for investors because it basically gives you next to free access to the stock market, which is certainly a great thing. And if you invested a big chunk of your money in index funds, which if you have a 401k or a similar type of plan at work, you probably have, then you've actually done very well over the last 15 years because these index funds are made up of the very biggest names, and these are the biggest stocks have done the very best. So I certainly think that index funds on net have been a big win for investors. And it's kind of gotten to the point now, though, where there's a lot of people out there. You can go on like the Boggleheads, message boards, or just kind of follow finance Twitter just even a little bit, and you'll see a lot of people are like index fund evangelists, right? What they'll say, the argument they'll make is, why would you pay for an investment strategy when you can just buy the stock market, get, you know, full exposure to the stock market, for next to free, and just benefit from the long-term compounding of returns. And they can cite studies and stuff like that we mentioned in the last episode, where index funds have a good track record compared to their active peers, right? So the question is, why pay more for an investment strategy when you can just buy the stock market? But I kind of, harken back a little bit to our conversation when we talked about behavioral biases. And, one thing that happens all the time is people performance chase. So the fact that index funds have done really well recently is driven in large part because the very largest stocks have done really well recently. So yeah, of course, those index funds are going to do really well. But my question is, what's going to happen if and when these mega cap stocks don't keep it up, right? And the rest of the market begins to pull its weight. Maybe international stocks pull their weight, right? And it's not just a story of the Magnificent Seven. What happens next? And I think that's when I'm a little concerned about people being a little over allocated to index funds. And basically, if you think about it, an investment in an index fund right now is an implicit bet that large cap stocks and the very expensive large cap stocks are going to keep outperforming, right? So you're basically betting on large cap, expensive stocks. And we know, if you look at the academic literature, the opposite style of investing typically is what is actually rewarded over the long term. So that means small cap stocks over large cap stocks. That's the size premium, and value stocks over growth stocks. That's the value premium, right? So over the long run, that small value style of investing has been proven to be a really good bet. So I just worry a little bit that people have loaded up on these index funds a little bit too much, and they're really expecting the largest stocks to keep doing well when, we've seen in the past, when stocks get to a certain size, it's very difficult for them to continue delivering the types of returns that got them there, right? So I wonder if it would help, investors out, maybe to have some exposure to general market stock market beta, which is what index fund will really represent. But it might really pay off to be invested in other areas too. Said a different way, if you buy an index fund, you're buying today's winners, but really what we're looking for is tomorrow's winners. And if you want exposure to tomorrow's winners, investing in just an index fund may not be enough. So it's a little nuanced there. It's not like
Hmm.
good versus evil. Nothing's truly good, truly bad. Just kind of nuanced. Adam, is there anything you'd add to my little dissertation there?
Well, no, just like anything, pros and cons, and it reminds me of something I saw over the weekend. I don't have quickly on hand a reference, but it was essentially a chart that showed the performance of large company stocks versus small company stocks over the past 20 years, and it showed how large caps have significantly outperformed their long-term average returns, where small caps have significantly underperformed their long-term average returns. And if you go back, whatever, 100 years, the length of essentially public market history that we have in the academic world, there's this talk of this small cap premium, meaning small company stocks over the long run tend to provide a return premium over and above large company stocks, which makes sense if you follow the laws of finance, which is more risk, more return. Small cap stocks tend to be more volatile. They are riskier in nature, and that these are smaller market capitalization businesses, so there should be extra reward over the long run. And that essentially has reversed the past 15 or so years, where small cap stocks have underperformed, in terms of what you would expect with that excess return. Large cap has shot way ahead of the curve in terms of its long-term averages. A lot of that driven by these big, massive, highly profitable cash flow generating growth tech companies. But things average out and normalize over time. So the general theme is it's not all black or white, but especially when you see this substantial level of concentration, having balance and the ability to get exposure to not just 10 stocks, but something far beyond that is of benefit. And the ability to rebalance is really important too, because there's something called reconstitution where these indexes reshuffle the deck, a certain number of times every year, and they re-weight some of these companies, right, Andy? Like where they
Sure.
re-weight them based
I've
on
got I've got
a number
Tesla
of
on here somewhere,
factors.
right? Tesla
Yeah,
famously wasn't in the S&P 500 forever, even though it was a size to get there. Just because I guess it wasn't profitable, it didn't meet S&P's criteria. So it was one of the largest companies in the world, and it was not in the S&P 500, right?
yeah, and certain
Um,
things might happen in between these rebalance states. Companies come in, companies come out, things are reweighted. And so these are set calendar dates.
yeah,
Is it quarterly for the S&P? Did I get that right?
I think so. Certainly not
Um,
more than that. I think it used to be even less frequent, and they've increased the
yes,
frequency.
yeah.
Yeah.
With all these ETFs now, it's more frequent. So if something happens in between the hash marks of a quarter, um, it's essentially buy and hold within those lines with an index. So another really important point.
Yeah, and let me just add this real quick. The thing that's informing my like nuanced take here on this is I look at like the big behemoth asset managers. So like no one is more index fund than Vanguard, right?
Hmm.
If they didn't invent the thing, they basically invented the thing, right? Like, they are the grandfathers of index fund investing. And so I found it really interesting when I look at their economists and what they predict as far as capital market expectations over the next 10 year. And they expect really poor returns out of large cap US equities over the next 10 years, something around 3% annualized, right? It's a similar story for Goldman Sachs, by the way, and their economists predicting subpar returns because they look at how massive these companies are, what their valuations are, and they just know based on history that when firms get that big, they tend to underperform. So it's really interesting that these two behemoth asset managers are actually predicting very poor return. So if large cap US stocks really do 3% annualized over the next 10 years, these index funds that people have themselves in, VOO in Vanguard's case, right? SPY, whatever have you, whatever measures the S&P 500, they're probably going to really underperform, right? Because they're going to be so exposed there. And I find it really interesting that these same firms, so Vanguard and Goldman, actually predict much better returns out of the smaller segment of the U.S. stock market. So whether that's the bottom 490 of the S&P 500 or going all the way down to mid caps and small caps, they're consistent in the predictions that these smaller companies will do better than the largest companies over the next 10 years. So I think that's a really interesting take. Obviously, we're in a market right now that's still being dominated by Magnificent Seven, but there's certainly no promise that that's going to last forever. And if and when they do slow down, it should pay off to be a little bit more well-rounded and, just make sure you're invested in some sort of material way to all segments of the market.
Yeah, and it's easy to forget there's been significant stretches of time where the headline index has been flat or negative for substantial windows. We all probably can more regularly reference the lost decade, the period coming out of the 2000 dot-com bubble crash where the large cap indices were flat to slightly negative over a 10-year window. We had a similar period in the hovering around the 70s, early mid 70s, into early 80s. Uh, so there are meaningful periods of time where the more closely tracked benchmarks deliver significantly lower returns in things like small cap value. Other asset classes can provide balance in those periods, and that's why it's so important to keep perspective during windows like this. And we all know, one of the questions I like to ask when I get into investment driven conversations with clients is like always trying to bring things back to why we're investing. Um, you know, w- Certainly we all have a target rate of return, something we're looking for in terms of performance over the long run, but we're investing for a reason. And probably one of the more the headline reason for most people is retirement. We cover the topic of retirement often on the show for a reason. We get a lot of great questions from clients about planning for retirement. So I'm going to pivot to topic number two here, which is a question I get all the time. We've hinted at it a little bit here and there over over a few episodes, but how much can I spend? When I get that question, you get that question, all advisors do. Someone comes to us and said, like, how do I budget? How do I know what I can spend in retirement? And it's usually a variation of one of three things. And I want to walk through the pros and cons and kind of best practices related to it. This is for all my engineers out there who come to me with a multi-tab spreadsheet and they've got their budget all figured out. They've got it line by line, however many cells across and down on Excel, down to the penny what they want to spend. And this is always amazing to see. These spreadsheets are getting more intricate by the week, and I appreciate their love of math and numbers more than anybody.
Look,
But I also,
I love a good spreadsheet too. Let me just say.
yeah, yeah, they come up with a spreadsheet. They say, here's what I want to spend. Here's my portfolio. Now let's run a plan. These are kind of this is kind of path number one. You come with a budget. You've got this all figured out and you want to kind of back into how long your money is going to last based on this very specific budget. The benefits of that is these people are not flying blind. They clearly have put some thought into this. There's no, oh, I've been getting a paycheck the last 20 years. Money comes in, money goes out, and I know I've been saving, not drawing down my assets. So that must mean something, but I don't know what that number is. So they've got some idea of their starting point for spending. It's a big benefit. The other big benefit is transparency is king. When you know what you're spending, you clearly are in a better position to adjust that spending if necessary in the future. You know and can identify areas you might want to cut spending or even maybe be able to boost spending if the plan says otherwise. So transparency is really the big winner there. Not flying blind and having some idea of your starting point makes it less underwhelming to do things like transition into retirement. The negatives of it is the budget never plays out the way people expect it to, especially when you budget down to the penny or even the dollar.
Can't be
The retire
precise, right? Like
No, you can't be
you can
precise.
never get that
Retirement is
right.
so different. It's so different than your working years. You have certain expenses that come off the books, certain expenses that come on. Your activity level in retirement changes drastically. Your interests change. You get a new understanding of what life looks like with you know a different set of circumstances. So it's really it's difficult when you anchor to a number and you have to adjust off of it. So I think that's something that people need to keep in mind who are our power budgeters is that I normally say the first 6 months especially you're going to learn a lot of things about what your spending is going to look like in retirement. Don't marry yourself to a number and be willing and flexible to adjust. So that's path number one for our super budgeters, people that are really math oriented and fixated on nailing a certain dollar amount of spending.
So let me just ask you this question. If I'm thinking about retiring and I have not created a spreadsheet to track everything, can I still retire? Am I being irresponsible?
Well, that's where path number two and three come into play. You're not being irresponsible. Uh, there needs to be some sort of a conversation or some level of planning that goes into taking the leap, but you're not totally out of the woods just yet. And that's where options two and three, I think, are going to come in and save the day. The second is people go to the old faithful, the 4% quote, I'm going to use their quotes, rule, which is not a rule, it's a rule of thumb. And it's a very basic rule of thumb that's married to some very specific assumptions and circumstances. It is not something I would retire purely based off of following the 4% rule. And for those who don't know what this is, it's essentially a way of telling you what you can spend from your portfolio. You telling us, here's my budget, here's what I want to spend. 4% rule says, here's what you can safely spend from your portfolio. So 4% times the value of the portfolio at a given year provides you with an anchor of what you can draw from it and adjust it for inflation over time. So if you've got $1 million portfolio, the 4% rule said you can spend 40,000 from this portfolio uh, and still be quote unquote safe in terms of not running out of money.
So what does the 4% rule miss though?
It misses a couple things. So the 4% rule factors in the research behind it assumed a 30-year investment horizon and a 50% stock and 50% bond portfolio. So it assumed a moderate asset allocation, not fully diversified, only somewhat diversified, and a 30-year time horizon, and it assumed no changes to spending throughout. And it doesn't factor in for things like starting valuations of the stock market, uh, one-off expenses or other things that might come out outside of just generic spending. Even the godfather of the 4% rule says, don't use this to make a retirement decision. He says, use it as a general, use it as an initial ballpark to give you some frame of reference, which I think is great for that. I'll do that with clients just to give them a very general idea of, early education on retirement 101 of what they can spend. But don't just make all your bets on this. It doesn't factor in healthcare expenses. It doesn't factor in maybe wanting to spend more early in retirement and less later in retirement. So there, you lose a level of flexibility. The positive is it's simple and it allows you to not have to sit behind a computer an hour a week and crunch in your budget and worry if you spend, an extra $10 on DoorDash delivery, Netflix, or any other miscellaneous expense, right? It's totally agnostic to how you spend your money. It just tells you what you can spend. So
Hmm.
that's the second method. The third and probably most academic of all of the options is to go with the guardrails based approach to retirement spending. And that's a mouthful, but I will explain exactly what that means. Essentially, in it sometimes the name of something is like simply what it implies. You think about guardrails, right? You're driving on a road, it's got guardrails on both sides. When you hit either guardrail, what do you need to do? You need to recorrect back to the middle of the road. That's exactly what a guardrail based approach to retirement spending does. It says, here's your portfolio value. If your portfolio goes up by this amount and hits the top guardrail, you can raise your spending. And if it goes down by this amount, you have to decrease your spending by a certain dollar amount. And those amounts depend on certain things. But essentially, what it does is it gives you a starting point, which is typically around the center of those guardrails, of which you can spend. The starting withdrawal rate, typically, depending on, just use very general terms, uh, depending on things like your flexibility to adjust spending, your time horizon, your portfolio allocation, this actually sets a starting distribution rate from the portfolio closer to 5% than 4, because what you're saying is you're not going to be static or beholden to a single 4% withdrawal rate. You're going to start at a safer level because you're willing to adjust if things move up and down, um, and adjust both good and bad depending on how the portfolio value fluctuates. So it really emphasizes flexibility. It emphasizes that you could probably start spending a little bit more than conventional wisdom as long as if the market falls 40%, you're willing to make slight adjustments to get yourself back on track. A lot of people like this because again, it's not requiring them to handcraft a budget and stick to it. It's setting a withdrawal rate. It's adjusting that withdrawal rate annually based on market conditions and how your spending changes. So, and there are and you've got the ability there to factor in other inputs like one-off expenses such as early retirement vacations, purchasing a second home, funding a grandkids, education. You can layer other aspects into the plan that you can calculate back into these guardrail amounts and essentially say and then the advisor wears the hat of, it's my job to keep you on the road. As long as you're playing on the road, we used a sandbox analogy a while back. Your advisor kind of keeping you on the sandbox of retirement and letting you live freely and enjoy things as you wish. If you want to do the slide or the swing, it doesn't matter to us. We just want to keep you in the safe zone. Same thing applies to the guardrails. It's our job just to monitor the spending keep you on the road. But that typically versus a static planning approach that's more linear, more fixated on one spending budget or one specific withdrawal number, gives people more flexibility to live a fuller retirement throughout their life. And we're seeing that in practice as we're coaching clients through this. And that's kind of the three pillars of potential ways to tackle spending. I actually find that people that stick to a budget, uh, and this is not biased towards engineers or mathematicians, but normally that budget in aggregate, I have found when people are that much of stickler with their spending, they tend to underspend, not overspend. And that's a risk too. You're right. The only risk for a lot of people is not
Yeah.
overspending.
You
Underspending is
you
a
earned
real
the
risk.
money, right? You earned
Yeah,
that money. You made great choices. Like you had a successful career. You invested wisely. Why not enjoy it a little bit?
yeah, yeah. But those three things, and I normally tell people, it's about finding your comfort zone. You don't, if you're used to doing the spreadsheet, you don't need to, right? Because transitioning out of work is a big deal. You don't need to jump from being in spreadsheet mode to now following this whole new approach, right? That could be
Right.
daunting.
Well, what I'm hearing from you is you want to go into retirement with a plan, right? You don't want to just fly
Sure.
blind. You don't want to YOLO it. You need to have a plan. But you also are recommending that you have flexibility to the plan, right? Maybe that
Flexibility.
means spend more. Maybe that means things are a little bit leaner right now. We need to spend a little bit less. But if you can have that flexibility and adjust to conditions in retirement, whether that's the market, whether that's your health, whether that's your wants changing, right? But as long as you're willing to adjust, that's kind of the best way to approach it. So you can do it with spreadsheets, you can do it with a rule of thumb, you can do it with the more academic exercise that you walked us through. But just have that plan and have that flexibility, and you're setting yourself up for success.
Yeah, and that's the job of the advisor to find what fits right, stick with it, and monitor it. So,
You're the
um,
autopilot, huh?
yes, yeah, the the non-autopilot that feels like an autopilot. Autopilot for the client, call it that.
Yeah.
Um, and one of the things we talked about was giving to kids and grandkids as being those like one-off items that might come up along the way. I don't know what it is, if it's, that we're hitting Thanksgiving and the holidays and giving is in the air. I've been having a tremendous number of conversations with clients looking to make gifts to their kids. They've been doing it in all sorts of creative ways. But it's just we're getting into that season, and in speaking with the kids and the grandkids of our clients, I love doing that. It's educational for them, and I love tapping into the next generation just to hear their investment perspectives and get their feedback. And one of the things that I thought was a data point that I wanted to explore was the idea of the younger generation having a lower risk tolerance potentially up to a certain point, and then the really young generation being like the riskiest risk takers I've ever met in my life. So it's like the
You're
millennials
you're
are
just
a little
looking for
more
those hot you're looking for those hot crypto tips. That's really what you're doing here.
yeah, like the millennials are conservative, but then the Gen Zers are like rocket ship. Give me the craziest, most aggressive investments you can think of. Neither that are necessarily advisable, but we pulled up this chart, Andy. Let's call it our chart of the week. Let's walk through it. What do you think about this? Age shapes our perception of risk.
Yeah, no, it's fascinating. Just to, I guess we'll put it on the screen for the video, but if you're listening at home, basically, it's a chart that shows people by age, so moving up every 5 years, starting at age 25, moving all the way up to 90, and then it's a bar chart that shows the number of bear markets experienced in their lifetime. Right. And so obviously, as you get older, bear markets happen about once every 5 years. The number has gone up. So, a 25-year-old has experienced four bear markets in their life, but a 90-year-old has experienced 17 bear markets. That's a lot of bear markets.
That's a lot. That's a seasoned investor. That's why our 90-year-old clients are such gunslingers. Uh,
Right.
they've
They've
lived
been
it.
through it. Yeah.
But I think I get it when it comes to the middle of the the middle of the pack here, because if you look at a 35-year-old, for example, has experienced 4 bear markets, but a 50-year-old has only experienced 6. So think about that gap. Someone who's 50 is closer to considering retirement, peak earning years, peak saving years. I think that really highlights the window of the late 80s through the 90s and that like really lengthy bull market. Um, and being able to participate that and what that's done, to investors in general. But seeing someone, kind of like not terribly off from our age bracket, mid late 30s, you know, coming out of college during the financial crisis,
Well, that was the big
you
one,
know,
right?
then you've
Because it
got,
Yeah, I was just gonna say, I mean, that one, and I know this one's doing, this chart here is assuming that all bear markets are created equal, but we've seen in recent years bear markets go, they happen incredibly quickly, they recover incredibly quickly, right? That was 2020. I'd even argue that 2022, even though the bear market seemed to drag on forever because it lasted about 9 months, it still recovered very quickly after that point. But like the 2008 bear market, right? That was truly a crisis, and it
yep.
took a long time for things to recover from there. So I think sometimes it's the magnitude, and when you're in your formative years, like what did you experience?
Yeah. And it's so important, especially for those younger investors that have, come out through that time period, experienced several bear markets already. It's really important to emphasize and learn from our 90-year-old investors that this is a feature, not a bug. And we have to encourage a lot of those young investors to think long term, right? Just think about the general principles of investing and what you can instill in your kids and grandkids. Just the simplest things go such a long way. you know, Diversify, stay invested, save whenever you can. If you do those 3 things, diversify, stay in the market, add money as you're able to, if you do those 3 simple things over time, you're going to be amazed just by the magic of long-term compound of interest, what can happen. So it's just been fun having those conversations and simultaneously talking with the millennial family members and like, hey, what can you tell me about T-bills? And the uh, the young, 20-some-year-old saying, what's the meme coin that you're going to put in my portfolio? It's just a sign of the times and just the difference in how we're exposed to the market and what that does to us and our ability to compound over time.
Yeah, I think it's interesting. Most investors, like you're gonna have successful investments, you're gonna have disastrous investments, right? So I think of people in their 20s as that's a great time just to experiment, right? Figure out what works, what doesn't work. And you really need an investment or two to go bust to really learn some lessons around, why diversification adds value. And, but then at the same time, if you invest appropriately in the stock market and you see your money double in 7 years or whatever, however long it takes, then that's a real confidence booster as well. So
Yeah.
I really do encourage people in their 20s to dabble in investing. Don't worry necessarily about making money or losing money. Just do some research, throw some money at something, see what happens. Because I think then you can really start to make some decisions with confidence and really understand these pretty esoteric concepts like diversification and a lot of things that we talk about here on this podcast.
Yeah, and I would say now that we're getting into like the year end, like what are some of the best, like what are some of like the really high impact tips for the parents and grandparents that do want to make gifts to their kids? And I think something that is often underutilized is gifting funds so that kids or grandkids can make a Roth IRA contribution. So say you've got a family member in their young 20s, they're starting out, maybe they're paying rent. They clearly have not hit their peak earning years yet, but they still have earned income. Gifting them $7,000 so that they can then in turn fund a Roth IRA, and doing that is going to be one of the more high impact things you can do in terms of not only making a gift, but directing where that gift goes. Uh, People always ask, what's the best piece of financial advice you have? Give me that one generic. And there's not many cases where you can do that. Everyone's unique. Personal finance is personable, but people in their young 20s being able to fund a Roth IRA, and sometimes with the help of their parents or grandparents, as long as they have earned income, could be something that, tax-free compounding for multiple decades can work magic.
Yeah, I have multiple clients who do this. One in particular will when the grandkids graduate college and get that job, they fund 5 years worth of Roth contributions for them, right? So, for the next 5 years, they give whatever the maximum is. It goes up through time. So $7,000 right now. And it really I think it's a great thing because it really sets those kids up for success having that nest egg to start with. Just because the way compounding works, you get a relatively small amount of money invested early so that it has many decades worth of time to compound. That can become substantial money when the starting investment really doesn't need to be that big. So that's a great piece of advice, for parents, grandparents, looking to help the next generation.
Well, all good topics, great questions this week. Please continue to submit anything you have to longstoryshort at Burney.com. We'd love to hear from you. And Andy, good luck trick-or-treating in that costume. I'll catch you next week.
If someone gives me an index fund, that'd be kind of a cool Halloween gift, though.
You're going to give out shares of index funds at your house?
I'm gonna give out shares of index funds to my kids instead of candy. I'm sure they'll love me for it.
Yeah, okay.
This podcast featured Adam Newman and Amy Pratt of Burney Wealth Management, which is a division of the Burney Company, an investment advisory firm. Adam is managing partner and is chartered financial analyst, certified financial planner, master of taxation, and retirement income certified professional. And Andy is senior partner and director of investment strategy and is a chartered financial analyst and chartered alternative investment analyst. Long Story Short involves general discussions of a broad range of current financial topics related to financial planning, taxes, investment, and retirement. This content is for informational educational purposes only and is not intended as personalized investment advice or recommendation. It does not take into account your financial situation. You'll need to consult with a qualified financial advisor or professional who is familiar with your specific circumstances. Investing involves risks, and past performance is not indicative of future results. The Burney Company is an SEC registered investment advisor. Registration with the SEC or any state securities authority does not imply the Burney Company or any of its principals or employees possesses a particular level of skill or training in the investment advisory business or any other business. Burney Company does not provide legal, tax, or accounting advice, but offers it through third parties. Before making any financial decisions, clients should consult their legal and/or tax advisors.